Why does the stock market panic every time the Fed raises interest rates? Why do your loans suddenly cost more? And what does this one decision mean for your wallet? Today, we're unpacking the real-world impact of interest rate hikes in plain English. Hey there, if you're trying to make sense of why the market acts crazy when interest rates go up, you're not alone. These changes affect everything from stock prices to home loans, inflation, your job security, and even your savings. But don't worry, we're going to break it all down using everyday examples and simple visuals so you actually get it, not just hear the terms fly by. Let's dive in. Let's start at the foundation. An interest rate is the price you pay to borrow money or the reward you get for saving it. Now, there's one rate that influences them all. The federal funds rate, set by the central bank in the US, that's the Federal Reserve. When inflation gets too high or the economy starts overheating, the Fed may decide to hike interest rates. That means increasing the cost of borrowing money. This rate hike doesn't just affect banks, it trickles down to your credit cards, mortgage rates, car loans, and business financing. So when the Fed acts, we all feel it. Think of the economy like a car. If it's speeding out of control, that's high inflation. Prices rise too fast. The Fed's job is like the driver tapping the brakes, raising interest rates to slow things down. When borrowing gets more expensive, people and businesses tend to spend less. And when spending slows down, prices can begin to stabilize. This is why you'll often hear about rate hikes when inflation is rising. It's the Fed's way of cooling the economy. This is where it gets interesting and a little dramatic. When interest rates go up, the stock market often reacts negatively. Why? Here are 3 big reasons. Borrowing gets expensive for companies. When rates are low, companies borrow money cheaply to grow, hire, expand. But when rates go up, loans get expensive. That slows growth. And growth is what investors love. Investors shift to safer assets. When interest rates are higher, bonds and savings accounts offer better returns. So investors move money out of stocks and into these safer options. That drives down stock prices, lower consumer spending. If people are spending less because their loans or credit cards cost more, companies make less profits. And again, lower profits mean falling stock prices. So when you hear about a rate hike, don't be surprised if you see red in the markets. Now, let's talk about bonds. Bonds and interest rates have a love-hate relationship. When rates go up, existing bonds lose value. Why? Because newer bonds offer better interest, so the old ones become less attractive. Think of it like buying an old phone when a newer, faster one costs the same. Who'd want the old one?